Welcome, everyone, to Name Confidential Live.
Welcome, everybody, to Name Confidential Season 2, Episode number 7. I am your host, Ben Fox, and today I have the pleasure of introducing our speaker, Chad Henry. Chad is a CFP and portfolio manager at Forthright Wealth Management. For 20 plus years, Chad has served as an advisor and financial coach to wealthy families, retirees, and professionals. Chad has been featured as a keynote speaker at dozens of respected industry conferences and teaches regularly throughout the country, where he guides financial professionals on innovative strategies and processes. Welcome in, Chad.
Yeah, thanks for having me. Glad to do it.
Definitely. We got the Valentine's Day show. What am I thinking? So we lucked out. So everybody watching, happy Valentine's Day if you're watching live.
Yeah.
Um, so I feel like I get the holidays pretty regularly on here. Um, So I will start off. I usually like to start off sharing the name exposure index. So I'm going to share my screen. And then, okay. So just a reminder for everybody, the name exposure index represents the average equity exposure to the US equity markets reported by our members. So it looks like last week's number we were at 84.91. We dropped about 10 points to 75.62. So we had a little bit of a drop there. Jed, do you have any thoughts on why we may have dropped, or do you kind of agree with that or disagree with the drop?
Yeah, no, I think it's smart. We've had a nice 2-year run coming off that last pullback in the market. And not only that, but you've got, we're still dealing with inflation issues, new president, or I guess new old president. We know some of the policies and maybe some of the viewpoints and things that they're going to try to change, or some of the changes that are going to happen. But there's a lot of things in the works right now that I think can create more volatility. So it makes sense to be a little bit cautious. Also, I think you've got kind of keep an eye on what the Fed's going to do this year, and everybody's got an idea, which is usually about as wrong as you can get in the last couple of years as far as what they're going to do. Or a lot of times they say one thing and do another themselves. So I think there's enough uncertainty, unpredictability that us at NAAIM are just saying maybe just take a little bit of caution, maybe pull a little bit of the profits off the table after a nice run. Doesn't mean that the bull market's over. It just means to watch for some volatility here in the next coming months as we start to transition through some of these new policies and tariff issues and inflation issues and that kind of thing.
Well, definitely. That was well said. I agree with it all. So we can jump right into it because I know you have a lot to share. Do you want to share a little bit about your investment philosophy? I believe you have something on relative strength that you think we could find pretty valuable over here.
Yeah, for sure. So, like most of the folks in NAIM, there's some type of a technical analysis component, if not backbone, to my process and strategy, just like everybody else's. And there are so many different directions that you can take. I mean, technical analysis, I guess, just like fundamental analysis, is very broad, and there are a lot of key technical points that you could look at or use for the strategy. The core of my strategy for the most part, is point and figure, and I utilize Dorsey Wright's platform to give me an idea of entry exit points, taking a look at risk on, risk off, taking a look at when we should essentially put the offense on the field or the defense on the field. It just like the name index, it gives me an idea of when there's really a good opportunity to take risk, and maybe when we should be more cautious, that kind of thing. Relative strength is one component of what I utilize to be able to identify maybe what to go into and when to go into it. And so I'll share a little bit of screen here and maybe go through it as you ask some of your questions.
Perfect. Sounds good.
You should see that opening Dorsey Wright screen when I first sign into the NASDAQ Dorsey Wright software.
Yep. Right now I see daily equities and market analysis.
Yep. And so when I go into this, I built some custom relative strength comparisons that I found useful, and I labeled it Chad's morning routine. So every morning when I before I start my day or before the markets open, I take a look at some of the comparisons. These initial comparisons are giving me a pretty good idea of risk on, risk off, where I'm comparing the 10-year, 2-year Treasury spread to the S&P 500, comparing gold to the NASDAQ, comparing money market to the NASDAQ, comparing the short the 20-year Treasury to long the 20-year Treasury, comparing the TLT 20-year Treasury to the S&P 500, comparing that Barclays Aggregate Bond Index to the S&P 500, and so on and so forth. So these first 13 or so I built myself to get a good idea of whether or not it should be offense or defense on the field. And as you can see, it's a mix there. So it's real similar to what you see with the NAAIM index in the respect of, it's not saying that we need to hunker down and 2008 is coming again, or 2001, 2002 is coming again, at least immediately. It's just saying that there's a little volatility, and there's a few indicators that are maybe showing that with that volatility, it's not a bad idea to have a little bit of defense on the field, or to take in some profits or reduce some risk. Still think the bull market's intact and going. But then at that same time, as I go down this list, if you notice, right now I have 98 different relative strength charts that I built. As I go down the list, it starts to show me some different entry and exit points for some of the either ETFs or some of the individual equities that I use on a regular basis. A lot of common names that probably most of the people who jump on this call will have in their portfolios, or that their clients own. And these relative strength comparisons, though, really help me do a good job of taking a look at, when something's getting too tired, or something's getting too overextended, and when something's starting to turn after it's had a pretty good sell-off and becoming a pretty good opportunity. I'll pause just for a second in case something, if you saw something on the screen or anything that you wanted to jump in on, Ben. If not, I can go into the next chart.
Yeah, so I might have a few questions. First one being the 13 that you have up there. How often do you change those, or are they pretty static?
They're pretty static. For the most part, I feel like they give me a pretty good indication. Some of them are really spot on. Some of them are they're kind of I would say the hardest one that I have, and this is probably like anybody on this call, is consistently in every type of market finding good short-term indicators that don't just become a head fake and noise that maybe gets you to reduce risk or gets you out of the market, maybe at times that you should hang on. The longer term indicators, or even the medium term indicators, I've got a pretty good handle on, and a high probability on those. And so, like, for example, I'll show you one here. This is SH, so short the S&P versus SPX at a 6.5 scale, which is essentially Dorsey Wright is looking at what they call a scale of, you could use 2%, 5%, you can use anything in eighth points. So it doesn't matter, whatever you want to use for the scale. And then essentially Dorsey's point and figure system has always been based on a 3-box move. So 3 times whatever you pick. In this case, it's that 6.5%. So it would be 3 times the 6.5%, or at least a 19.5% outperformance for it to switch from one to the other. So right now, what this is saying to me is that short SH is in a sell in a column of O's, which means that it's actually accelerating in a negative pattern. So you wouldn't want to short the S&P right now, even though there are some indicators that kind of indicate some more volatility. But I'll show you when this does work on a handful of times on a long-term basis, it works really well. And so I'll pull up this chart once and show it to you. I think you'll find this of a pretty good interest here. So this is going back, if you notice at the top of the screen, this is based on the year up here. So when you see like the 2000, 01, 02, 03, this is the year. Each of these gray lines that are going down is the changeover from the one year to the next. And so when this is in a green column, essentially, it's saying that, it's risk off, should be defense on the field. And I apologize, I actually grabbed the wrong chart. That's actually gold versus SPX there. So I clicked on the wrong one. But give me 1 second and I will fix that.
Makes a little bit more sense now. I was like, wait a minute.
Yeah, and that's actually a great one too, I could show you. But Yeah, so the same kind of thing here, and I'm just going to pull it down. It doesn't trigger very often. So if you look, I mean, this isn't something that's real, that's jumping back and forth all the time. But when it does happen, you have to take notice of it. So, it's showing you, for those of us that have been around, for 25 years or so, it's showing you, in essentially the 90s, awesome decade for equities, and it is showing you for the most part you're in these downward columns on the SH, where you've got the red sell signal on SH with followed by the white column of X's and O's, signaling that you wouldn't want to be short, you would want to be long the S&P 500. Only when it's in this green area is when you'd actually want to go short. And so you pretty much went most of that entire decade being long and being in equities. But then right when you came out of it there, and it's not going to be exact, but it signaled on 3/12 of 2001, essentially you're going to want to go risk off, whether that means for you to go to cash, whether that means for you to go to short, whether that means for you to maybe do an alternative like the TLT or gold or some type of currency. There's a lot of different things you could do with this, but I use it first and foremost as a risk on, risk off, either the lights are on or the lights are off kind of indicator to tell me whether I should have more offense on the field or defense on the field. And so in 3/12 of 2001, it told you the defense is on the field. And as you can see, it's pretty consistent here. It pretty much kept the defense on the field most of the time here, all the way until, and if you remember, this is the start of that lost decade for the S&P 500. So, from 3/12 of 2001 all the way until 5/30 of 03, it said, listen, you really don't want to take a lot of risk. This is kind of some downward pressure on the NASDAQ, the S&P, and just on equities in general. Then on 5/30 of 03, it says, you know what, you can go back into equities, and it keeps you there from 5/30 of 03 until essentially 7/7 of 08. So, now you've got, this nice 4-year run or so in the market. It's not, it's not going in and out every month or every 3 months. Then on 7/7 of 08, it says, hey, risk off, take some portion of your portfolio, take in some profits, reduce your risk, and it takes you to risk off, or you could go short or whatever, from 7/7 of 08 until 3/17 of 09. So it's a and if you did depending on if you use the reversal signal or the sell signal, your risk off from either 7 of 08 to 3 of 09 or 7 of 08 to 6 of 09. Either way, you missed a lot of that storm that was pretty ugly, as we all remember back in 08.
Okay. No, I'm following. I'm trying to figure out what are the numbers in the red boxes. It's kind of small for me to see.
Yeah, let me blow it up a little bit for you. Yeah, so the way Dorsey works essentially, so anytime you see any of these numbers, 1 through 9 is just the month. So 1 is January, 2 is February, 3 is March, so on and so forth. Then once you get to September, you've used all 9 numbers, and so then, pardon me, then you get to October, that's an A, November is a B, December is a C. So it's telling you kind of what month it happened. And then when you see the darker, whether it's a dark red or a dark green, that's either a buy or a sell signal that triggered by having either a lower low or a higher high than the column before. So in general, in a good market, you're looking for higher highs and higher lows, that when it does pull back and take a breather for a little bit, that it only pulls maybe halfway back in that trading range, it regroups, lets some more people in, and then pushes higher. So you're looking, for lower lows and higher highs. I should say you're looking for higher lows and higher highs in a good market that tells you to kind of stay involved. When you're seeing that negative trend, that's when it's telling you to kind of take risk off. Now, in this case, I'm actually saying, or at least, for this indicator, I put SH as the first symbol in this relative strength comparison. So here where it's green, it's actually saying this is risk off. So this is your first buy signal on this risk off signal. And so it's in the 3rd month of the year. And it specifically tells you, if you right click on Dorsey's chart, that it's 312 of 2001 is when you wanted to go risk off, at least based on this indicator. That, and this is all built by me. I mean, you can pick the scale, you can adjust it any way you want to. Like if I go back up here, you see where default, or I've got 6.5 in here. Well, I mean, I can put, 6.375, whoops, or anything in increments of an eighth of a percent, and then it's going to redo the chart and the comparisons based on that, and it's going to make that change based on that. And let's see, so before it was telling me 312, it still says 3. Yeah, see, now I changed that by an eighth, and now it says, the exit point is 3.2. So then it's a matter of me going back and taking a look at that to say, okay, is that a better exit price, or does that give me too much of a whipsaw? Or which one, at least in history, not that the past ever is any indication of what the future is, but which one at least it looks to be over different market cycles to be a good indicator of a risk off or risk on type of a situation. And whether it's 6.5 or 6.375, if you look at this real quick, it really triggered risk off once, twice. Let's see, 3 times. It only triggered it 3 times in 35 years. But when it did, it was those major market meltdowns. And it's not perfect by any means, because it did a really good job in, I think, 2000, 2001, early 2003. It did a great job in 2008, 2009. It did an okay job in 2022, but that was a little bit of a different market with the interest rate environment and inflation and COVID and all those things that hit us at once. It wasn't like, it wasn't as when the housing meltdown or the tech wreck happened, certain things just went, down extremely fast. And it just seemed like everything just kind of slowly melted in 2022. And then some of the safe havens, like the 20-year treasury or gold, or some of the things that might have worked really didn't work, or even bonds that might have worked to kind of offset some of that downturn, honestly, were some of the worst places to be. So 2022 was a bit harder, but this work, only triggered 3 times in about 35 years. But when it did, 2 of the 3, it really protected you from most of those downturns.
So then when you're going through and looking at the percentage, are you trying to get it as specific as you can? Like you said, 6.5, you have 6.375 right here. When you're kind of testing, are you moving that up slowly and
so
affect it to where you see it?
Yeah, exactly. So when I'm testing this, and I'll use, because I don't think any of us have that one, or if you do, please let me know what it is. But I don't think anybody has that one indicator that seems to just be the best indicator that always is very accurate in all types of markets, to indicate risk on, risk off, or to indicate maybe when we should be hunkering down, or maybe going short or hedging or whatever you might do. And so this is one, like I said, of like 13 different ones that I use. And so I'll essentially look at this, and then in context with several other ones, start to put together or aggregate those to give me a better picture of what I think the market's going to do. But yeah, when I'm testing this, I can put in different box sizes to get an idea of where it works the best. I don't necessarily want something that is triggering every 3 months, where it's maybe it's getting you in and out at the wrong times, and it's happening too often, and it really, I want something that when it's really, I don't want a bunch of false alarms. I want something that really does the best job of protecting my clients. But at the same time, for the most part, you want it to be long more often than not over the last 35, 40 years. And I want something that kind of replicates that. But when it gets really ugly, like a 2008, I'd like something that gives me an idea that gives me peace of mind to know that I should be. And I'm not saying that any of these indicators are saying go 100% short or 100% cash, because I don't think there's anything that has that kind of clarity. But even if you were to take up, depending on your own philosophy, even if you were to take a portion of your book and either go short as a hedge or increase cash or go to other non-correlated asset classes, it's just going to show value to your clients and at least show that there's a plan and a process in place, which I think is important to most people.
Oh, definitely. So the 13, do they have like a static weighting between them, or do you weight them differently at different periods? How do you go about that?
Yeah, no, I mean there, and it's something now that part of it, as far as the weighting, I'm always back and forth with and adjusting and trying to figure out the best methodology. But for example, this one, I like this one a lot in the respect of it doesn't happen very often, but when it does, you should really take notice because it really is a huge advantage for you and for your clients. I'll also go back and so this is one that I definitely put some pretty good faith in because it's only happened 3 times in 35 years, and when it did, 2 of the 3 were right on and pretty much missed a lot of that volatility for your clients and got you. But it's not so much about being right about getting out of the market. It's just as much about having that process to tell you when to get back in. That's tough for a lot of people too. And this has done a pretty good job of that also, where you're not missing out or getting whipsawed a lot. I also, even that comparison, looking at, say, gold to the NASDAQ, those are, pretty much polar opposites for the most part. And so, I'll pull this one up, and I like this one a lot. Now, it's a little bit, unpredictable given the inflation that we've experienced here recently. So it's done a little bit more of I would say triggering. But so when it's in the green again, and here's that 3 again. So like for this example, it's got it on 3/7 of 22. It's saying, listen, buy gold, get out of the tech stocks. And it kept you out from 3/7 of 22 until this red over here, which is 5/18 of 23. And the tech stocks started to take off actually right after one of our NAAIM conferences. I think not too long after one that we had in Chicago back about that time, and or maybe it was right around that, a little bit before that. But right around July of 22, after they've been hit so hard in the first quarter and part of the second quarter, tech stocks started to take off. But even at that time, from a risk reward based on this scale, and if you notice, I used a 3 scale here based on my testing. And so that what that means is a 3% times 3 box reversal. So it means that essentially in any time period, it could be 3 days, 3 weeks, 3 months, that gold had to have an outperformance of at least 9% versus the NASDAQ or the Qs. And so, for example, it could be that one fell 4.5 and one gained 4.5. It could be that one stayed flat and one gained 9. It could be that it could be a huge. I mean, it could be a 18% difference where they both went opposite directions that fast, kind of thing. But as soon as you have about a 9% difference in performance, this thing's going to trigger and it's going to reverse the trend. And this again doesn't happen very often. If you look at this on this chart here, you're looking at again 3/7 of 22 to essentially 5/18 of 23, and then a spot here in early 20 when we first had that COVID scare, and then some areas here in 16, 17, and part of 18 where we had that big downturn in December of 18. But then you really had you hold the cues sometimes for here's most of 13, 14, 15, 16. Yeah, you were in the in this spot here, you were in for like 4.5 years.
Yeah.
So it's not just jumping back and forth. And then when we had that lost decade and the market cap weighted like the S&P 500 and stuff didn't do anything for 11 or 12 years here, from like 2000 to 2012 or 99 to 2011 or whatever you want to say. It had you in gold quite a bit in that period where we had some inflation and had some underperformance with equities, and honestly proved out to be pretty good. Even again, here's that 2008 meltdown. So it takes you out. This actually triggered on 11/8 of 2007. And then it had you out all the way until 8/14 of 08. And then at that point, you would have got in for just a little bit and had a little bit of a head fake. But then right away, essentially on 9/29 of 08, I think that was about when Bear Stearns or Lehman went out. It puts you right back in from 9/29 into gold, again, all the way till 10/30. And then you had a little spot here, and then it gets you back in again from 11/20. And then this is, it's turning on, I think essentially the bottom was 3/9 of 09, if I remember right. And this is telling you by 4/3, you're back in and you're long again the market for like another year here. So, and if you actually go back and trace these entry and exit points, and you start to take this one with gold, and then you start to overlay the short, in some of these same time periods, and then some of the other ones, it starts to paint a pretty good picture of, if you get 4, 5, 6, 7 of these pointing to the same thing in roughly the same time, a lot of times they're only a few months apart, you should really start to take notice and start to reduce risk. I mean, a lot of these trades worked out extremely well. Not always, they're not perfect, but and even down here at the bottom of Dorsey, it actually tests the strategy. So when you do make these adjustments, I use this box size of 3%. So then down here, it's showing you each of the trades and the switching. So this is if here in the first column is if you bought gold, and it tracks back to, in this case, 4/2 of 93, you put 100,000 in gold and just held it the whole time. This is if you put $100,000 in the NASDAQ, the Qs, and held it the whole time. And then this is if you followed the strategy based on switching at the 3% box size times 3 boxes. So if you held the gold the whole time, the 100,000 becomes 799. If you held the NASDAQ the whole time, it becomes about 6.3. And if you did the switching, it becomes about 6.8. Now, that's not the whole story. I mean, it's always nice to get 500,000 of outperformance if that were recreated moving forward. But it's some of the volatility that you didn't experience. I mean, you didn't have a real bad 2008 like a lot of people did. In fact, if you look, this will actually show you that trade if you go back here. So you've got right here. So 11/8 of 07, it tells you to essentially buy gold and sell the Qs. And so at that point, you're at 1,571,000. And 8 months later, you're at 1,516,000. So, you're down, a little over $50,000. But if you would have stayed invested in the NASDAQ, you went from 564 to 442. So you lost 120. I mean, that's a lot of outperformance there and a lot of volatility you took out of their portfolio. And even when it, as it gets, at the bottom of 2008 and gets fairly ugly, you're down to about 900, whereas you're only at 400 if you just bought the Qs and held them the entire time. So you still have 2.5 times the money. And then as it rebounds and you're switching again and it gets you back to risk on, you can see how quickly it escalates versus holding either one and how fast, it's going through some of these times, especially some of the rough ones. And you just don't have the huge downturns that you do when you're just buy and hold.
That's very interesting. I do have a question. Out of the 13 that you have, if you could only pick one, which one would it be if you had to just follow one of them?
Boy, that is a wonderful question. I would say if I was forced to watch just one, and again, it's, you really have to put a bunch of them together. But one of the things, the currencies, I think are a good indicator of what's happening in the market, whether it's 2008, whether it's 2022, whether it's 2001, 2002. So, in this case here, I'm comparing UUP, which is the ETF, one of the ETFs that track the US dollar, to the S&P 500 at a box size of 1.875. This does a pretty good job of indicating, and this is more of a shorter or medium term. You got to put this with other stuff though, because essentially, like here, for example, it would have told you risk off on 1/27 of 22 all the way until 10/25 of 22. So, there was some pretty good damage done in those, first 3.5 weeks of January of 22, but there was a lot more done over the next 4, 5, 6 months, and even leading into the volatility we saw in the fall. And this essentially had you in gold, if you were going to do it that way, or just had you risk off, whether you wouldn't want to go to long-term bonds, obviously, because of the rising interest rate environment. But this would have had you essentially out of the market, or shorting the market, or shorting the using the PSQ to short the Nasdaq on 1/27, and not getting back in or putting risk back on until 10/25 of 22. And then this is all risk on here from 10/25 of 22 using this indicator. This one's pretty good. I mean, this one, same thing back here. If you go back and look at 08, this again, this one took you out 7/15 of 08. It said, risk off, and it didn't let you get back in until essentially 12/8 of 08. You had, some back and forth here for a few months, some chopping back and forth. And then it got you back out again from 1/13 of 09, but it puts you back in, and you go long again, almost, within 3, 4 weeks of the bottom, because the bottom, I believe, was 3/9 of 09. And this has you going in on 4/3 of 09 after you missed most of the worst of what happened in 08. So the signals here are really good. Same thing with commodities. I guess I like watching, when you see the dollar really get strong, or when you see some of the foreign currencies, the yen carry trade is somewhat unwound, but in this period, if you were comparing FXY to SPX on a similar scale, you'd start to see that the Japanese yen was really moving up compared to the strength of the stock market. And again, that's another indication of risk off. Put your money into currencies, put your money into gold, put your money into treasuries, put your money into short-term money market or T-bills, or whatever you want to do. But essentially, it's a pretty good indicator of risk off. So I guess if I was going to pick one, it would probably be how the dollar's reacting.
Great. Well, I'm looking at the time here. Do you have what's the best way to reach you? If somebody's watching this and they're finding it very interesting and they maybe want to dive in deeper with you or explore some things.
Yeah, they're always welcome. If you look at the NAAIM phone list for the members, you can find me in there. My email's in there. My phone number's in there. They can email me. This is more on the personal side than the business side necessarily. So it's just, so they can email me my personal email at chenry13099@gmail.com. And just for 30 seconds here, if it's okay, I'm going to show you one more thing here real quick. Because, I addressed kind of the risk off stuff, but then I also have built a number of these to tell me entry and exit points for some of the favorite, especially the more of a polar opposite you can get for a comparison in these relative strength comparisons, the better off you are. And so I'll just show you one real quick, and I could really pick any of these randomly. It doesn't matter, but I've got this one I built for Tesla about 6 months ago, and it's comparing Tesla to the Nasdaq at 1.5. So essentially, when Tesla is underperforming the Qs by about 4.5%, or outperforming the Qs by about 4.5%, it's saying to put Tesla on or take Tesla off. It's not so much risk on or risk off. It's more of a comparison of this is when you should invest in Tesla, or maybe when you should take in profits. And we all know how volatile it's been. When it's good, it's good. And when it's bad, it's bad. And so if you look at this, I think it's pretty interesting for most people. So over the last few years, or even going back, I guess, a number of years, this essentially told you, if you look at it here, this last fall, buy Tesla 10/25/24. Well, that's after it was really pretty beat up. It went through this pretty good downturn after it had a little bit of an upturn last summer, and was really beat up. And it's only a 2-month trade from, it tells you to get in on 10/25 of 24, and it tells you to get back out on 12/31 of 24. And I just know this from knowing these charts, but I think that was about 50% return in 2 months. Since then, and this is as of last night, it looks like it may have had a little bit of recovery here in the last day or so. But as of last night, since it told you to get out of Tesla, I think it's sold off like 16 or 17% in the last 6 weeks or so. And if you look at this, this is a great example. So when Tesla originally IPO'd, so you trace it back here, and this is just using $100,000. You bought Tesla. You were that super smart, really lucky person who knew on August 6th of 2010 Tesla was going to be this great thing, or reinvent this category, or however you want to put it. And in this case, you were just like, hey, we came off this 2008, 2009. I'm going to put $100,000 into the Qs. Well, or this here is my relative strength switching strategy using this formula that I developed. And so this is showing you all the way along kind of the trades, and there's more trades here because it's just what I found to be the most effective with Tesla. But if you look up here, and we'll go back towards the top, so when you get to the end of this, after you've got these 14 years or whatever of different trades in and out, essentially, had you held Tesla the whole time, still really smart, you turned 100,000 to 27 million. That's pretty cool. NASDAQ would have turned 100,000 to 1.1 or a little more. The switching strategy here would have turned it into 78, about 3 times what just buying and holding would have done, with Tesla. So, this strategy works really well. And it's funny, but you could pick just about any of these out, from here to here, it's a couple months, and in early 23, I think that was 35 or 40%. And then this drop was like 40%. And then this entry was like another 30. And then this drop was like 15. And, but if you actually take all these entry and exit points, they're not all right. But I think when I analyzed all of these trades and all these entry and exit points, 78% of the time, it was a good trade for the since Tesla IPO'd. I mean, I don't know how many of you are right 78% of the time, but in the market, if the future works the way the last 14 years did with this essentially with this strategy, or anywhere close to be right 78% of the time with this kind of volatility, really puts the odds on your side. And when you are wrong, the average downturn was about 4%. When you were right, the average up was about 12. And these are usually, now again, you got to be cognizant of taxes. You've got to, you probably want this kind of strategy in some type of a tax sheltered account, because a lot of these are shorter trades because Tesla is so volatile if you're going to use these signals. But you can see the advantage in something like this, 27 million versus 78. And it doesn't matter what number you put. I mean, it's just as simple as if you started with $5,000 and reduce these numbers drastically, it's still roughly 3 times the money over the last 14 years or so.
That's crazy to think about.
Yeah.
78%, that's pretty high.
Yeah. 78 million. So that's actually it's taking $100,000 when Tesla IPO'd and turning it into 78 million. And this shows you every trade when it triggers and kind of what the results are. So like here, you go from 100 to 114 to 131 to 140. Now this one's a loser here. So this fifth trade or whatever, you're down $2,000, but still not much. Then back up to 142, 131. So you kind of see it, piece it together. And then if you don't like this, but what I try to do is I'll take this, I'll dump it into Excel. I'll look for how often the trade was right, how often it was wrong, and then I'll look for the percentage of gain or loss when it was right or wrong to assess whether or not this is a good strategy. And then I'll go back, because up here at the top in Dorsey, you just click this right here and it dumps all that data for the last 14 years for Tesla and all those trades into an Excel spreadsheet for you. And then you can go through and dissect it any way you want. And if you don't like I look for consistency, because I don't think we're always solving as advisors. I don't, it's as much about, it's as much about that emotional quotient or that behavioral finance or more than it is about the best total return. So, you could get $100 million return, but if it's too volatile and you can't keep people invested, nobody's going to be there to enjoy the party. So I try to look for consistency of trades, and I obviously want to have a number that shows an advantage to the strategy, but I also look for consistency that, way more often than not, when it told you to do something, it was right. And that when it did, the upside was better than the downside when it was wrong. And so I'm also weighing those out, upside versus downside, percentage of correctness. Sometimes I'll do a strategy and find out that it's only right 48% of the time. And I'm like, well, it's wrong more than it's right. That might not be terrible if the upside trades are better than the downside, but I look for consistency. And then if I didn't have it here, then I might plug in, a different number. Let's say, go up an eighth, 1.625, and test it. It does it just that fast. And so now you notice it was 78. Just that 1/8% changed it from 78 over 14 years to 51 million.
Oh, wow.
So there's some big changes that happen, based on the volatility. It doesn't take much of a change to change the formula drastically. So there's times where I'll spend, I don't know, 10, 15, 20 hours just on one relative strength chart, and then realize that there's not a good comparison. You have to really have something that is a good comparison. When Tesla drastically outperforms or drastically underperforms the NASDAQ 100, its peer group, really, it's something you want to take notice of. And I think it's a great comparison. Sometimes you have like polar opposites, like if money markets drastically outperforming the NASDAQ, okay, well, why is that? It shouldn't be. That's definitely got to signal something that you should be doing, whether that's reducing risk or in the opposite, maybe increasing risk if you've got a huge outperformance of the Qs over money market. But when you see it once in a while trigger, and something that's supposed to return a couple percent is all of a sudden beating something that's maybe has been historically returning 10, 12, 15% a year, you probably want to take notice and act accordingly. And so I've built all these relative strength comparisons. I think right now I've got like 95 of them, 98 of them. I've built all these, and honestly, I've maximized all these over hundreds of hours, probably thousands of hours of work over probably 10 years on just these charts and stuff. So, Palantir, everybody's wondering, okay, this is another good point, and I'll let you go on this. I know we're over a bit, but everybody wonders, like those stocks like Nvidia and Palantir and some of those that maybe you don't get right away, and all of a sudden you feel like it's run away from you, and you don't jump in, and then it goes up another 50% or another 100%. Sometimes you catch the trend late, but the trend's still going, and until it's not, as long as you got higher highs and higher lows, even if it's up a lot, it may still have a lot to go. But a lot of times they overdo it on the upside, and so you can use, like, this is comparing Palantir to XLE Energy, and it just gives you an idea. When it's in green, it's saying you should buy Palantir. When it's in the white with red, it's saying you should buy XLE. And this is only going back because Palantir is fairly a new IPO, so it's only going back to November 5th of 2020, putting in $100,000 into each. If you put $100,000 in held Palantir, you have 10 times your money in 5 years. So you've got 100,000 becomes $1 million. If you did it with XLE, you got 3 times your money. So either one of those are pretty good. I mean, that's pretty outstanding, actually. You got 304,000 because energy did real good most of the time over the last 3 or 4 years. But if you use my switching strategy going back between the two, and when one got in trouble and was under pressure and was selling off, you switch to the other one. Over the last 5 years, you actually have 26 times your money, or almost 2.7 million on $100,000 from 5 years ago. So, some of these can be really powerful, and it's just how you use it. You can use it as risk on, risk off. You can use it as entry and exit points. But it told you to essentially buy Palantir back here on 6/17/24 and still hold it today. And I'll just show you this real quick, and this is it. So you go up here, you change it, go 6/17/24, and this is as of yesterday's close. Update it, and then I just got to move it over because I've got a little bigger to see better. So I will move it over, and this upper right corner is what Palantir did since it told you to buy it. essentially 8 months ago. No, actually,
Oh, that's a 12/31.
yeah, that
Yeah.
should be 8 months, but that's only 2 months because that's how much it's done. So it's done 55%, but it told you to buy it. I think it said 617. So on June 17th, I believe,
Yeah.
and then update
Yeah.
and scooch it over, back up. No, it wasn't 617. I apologize. 1 second here. Little technical background here. So double time. Yeah, so oh yeah, duh. It did tell you to buy 617. So
Okay.
I didn't have, I had it in the wrong, so I had it like 4% on one of these, but I had to move it back up. So here's Palantir going across. You see when it told you to go in was 617 of 04. At that time, I'm sure, it just came off a run. It had a little bit of a setback. It probably was up, who knows what the first few months of that year or the year before. I mean, this thing's been kind of hyperbolic the last few years most of the time. But from 617 in the last roughly 8 months, it's up another 371% when I told you to enter. And these relative strength comparisons are just a good. And in the same time period, you've got an S&P that includes the dividend up 1265. So quite a bit of alpha there for you. And again, this is another one of those charts I prepared using Palantir versus XLE at 3.125. And it's showing you the entry and exit points. There's not a ton of them. Even with this one, it's usually pretty decisive whether you should be in or out. And when you should, it's good. I mean, some of these trades are 5, 6, 7 months. It's a really, volatile stock that's really moving. But at the same time, when it starts to move down, it gets you out and you miss all these downs. So, you're not going to miss everything, but I'd rather be down 5 or 10% instead of just sitting there on my hands and watching like this kind of situation here. It told you on 11/9 of 21, sell Palantir and buy oil until essentially 3/29 of 22. And so, and I do promise this is the last one. I know I've said it 3 times, but it's kind of fun to show you some of this. So 11/29 of 21, it said sell it until I think I said 4 of 22. Didn't I? Let's check here. Yeah, until 3/29 of 22. And so you'll see what Palantir did in this short period.
So that's looking at 25, isn't it? Yeah, 24 now.
Let's see.
I think we have to switch the end year. It has it at 2024.
Oh. And obviously you don't have to be super good with these charts to be able to be good at this. Not just teasing. So yeah, so here, and I think, what did I just say? 328, didn't I? Of 317.
Yeah, why is it not going? Oh, there we go.
Yeah, so then I believe it was 328, and normally you don't have to scroll down and scroll over. It's just that I made this bigger to make it easier to see at home. So yeah, it was down 36% in that range where it told you to sell in those, roughly 5 months. It's down 36% after it just had a really good run in that period right before it. And again, like I said, this is it's pretty decisive of what to do. It's not a lot of head fakes. There's some noise once in a while. Not every trade wins, but it's pretty clear to see the advantage of using relative strength in some way in your portfolios. And a lot of us do it just in different ways, but I think Dorsey has probably one of the best ways to do it, one of the best comparison tools that I've seen on different software. So I think that's, as you can see, I could go on and other stuff, but I think that's a great spot to maybe turn it back to you, Ben. I appreciate you asking me, and I really, I think I've benefited so much from NAAIM over the years of being a member and attending the conferences and all the calls that you put on, all the videos. So I can't thank you all enough. You and Susan and the board and the rest of the group, I think, do a wonderful job at helping us, collaborate and share some of the best information out there. So thank you.
Definitely. Well, thank you so much for coming in. That was great sharing all that. And I'm sure somebody's going to reach out, if not myself, to dive in deeper. So Yeah, well, thank you. And
Sounds
I
good.
think
Thank
that's,
you.
yeah, definitely. Next week, we'll see everybody here next Friday for the next show of